QuickBooks Pro Plus Desktop 2022 presentation, Invoice Form. Get ready because we bookkeeping pros are moving up the hilltop with QuickBooks Pro Desktop 2022. Here we are in our QuickBooks sample file, sample rock castle construction, going through the setup process, starting with the View tab dropdown, going to the Open Windows so we can see the Open Windows view on down below. I'm going to give us a little bit more space, moving this item down. Then we're going to open up the home page, company dropdown, home page, opening up in the middle of the gray area. I'm going to maximize it. So it's maximized in the gray area. Then the financial statements, starting with the balance sheet report, reports dropdown. We're going to go on down to the company and financial, on down to that balance sheet standard report. Now opening up the income statement or profit and loss report, reports dropdown, company and financial, going on to that profit and loss, P&L, otherwise known as the income statement. And we'll change the dates from January, just starting off for the entire year here. So now we have our open items on the left-hand side. Going back to the home page, we're focusing now on the flow on the customer side of things, which you could call the sales flow or the accounts receivable or revenue type of cycle. We're going to go through the full cycle or start the full cycle for an accrual process, which would start with the invoice. So our focus here would be on the invoice. The invoice is going to be the documentation for the type of company that does work before they bill the client, meaning they're not getting paid at the same point in time. They're doing the work first and then typically have to bill the client. That usually is going to be some kind of job cost system, whether that be a job cost system for like a construction company or like a law firm, bookkeeping firm, where the work is done. We calculate what that work that has been done in some way, shape, or form typically, and then bill the client with an invoice, sending the invoice then out to the client. At that point, we then have to track the receivables to see whether or not we get paid on it. Once we get paid, we go to the receive payment, and then of course we make the deposit into the checking account at some point in time. We want to make sure that we're sitting on the right side of the table when we're thinking about the transaction with regards to an invoice in relation or opposed to a bill. A bill and an invoice can kind of been used interchangeably in practice, but when you're looking at accounting software, like QuickBooks, the bill means that the vendor is billing us, meaning we're going to be eventually paying the bill, outflow of cash eventually, and the invoice means that we're going to be invoicing, in essence, billing the customer. Therefore, we should have an inflow of cash at some point in time. Now, if you're in a job cost system and you have some kind of estimate first, you might make the estimate, which would have no transaction recorded to it, but that could get an estimate to get the job going and then flow into the invoice at a later point in time. And let's go into a practice invoice here, see what they will look like. I'm going to go back to the prior tab to find a prior invoice that has been input. So here's the invoice. I'm going to close this item on the left so we can maximize more of the screen. On the right-hand side, you're going to have some data summary, including the email and some of the data input with regards to the customer, unbilled time, and then recent transactions on down below. I'm going to go ahead and close this tab. Let's take a quick look though on the transactions. We got the amount of the transaction, the creation by the admin, and some data here, last edited information, which could be useful to track. I'm going to go back to the customer and then minimize this tab so we can see more of the invoice. Now, most of the time, once the invoice has been set up, and we will go into some processes to make the data input for the invoice easier, then you're going to go right into the invoice and go right into the heart of it, selecting the customer and the related items. In order to make the generation of the invoice quicker, then you got to make sure that we set up the items properly. These are the things that we provide to the customers, the goods and the services, whether that be invoice, inventory, or services we will provide. So that's one of the more tricky things within QuickBooks. When you first start the QuickBooks company file, is to set up those items properly to make your invoicing process as easy as possible. Once set up, then you setting up the invoice or creating the invoice should be just a matter of data input and should be a fairly easy process. So we'll talk more about that and get into that in more detail when we go into the practice problems setting up those items. Let's go over the items on the top. Like I say, normally when you dive into the invoice, you'll be down here with the data input, but let's just run through the ribbon up top. We go back and forth to the prior invoices. We can create a new one. We could save. We could delete it here. We can create a copy. We can memorize it. We'll talk more about memorizing transactions at a future presentation in kind of section of its own. We can mark it as pending. We can print the invoice or email it. The invoice is one of those documents that is not just a data input form, but also a form that we are going to be providing outside to the recipient, to the people that we're billing, in essence, for the work or goods that have been sold. Therefore, we might want to print it and then send it by email, or we can print it later, or we can email it directly if we're kind of connecting our email to the QuickBooks system. We can attach documentation to the invoice, so any supporting documentation we might want to upload here. We can add time costs, apply credits. We could see the progress, receive payments. So this will basically link us to the receive payment item, which is going to be like the next part of the cycle. We invoice and then we receive the payment. So one way that you could receive the payment is find the invoice first and then open the receive payment from there, and it'll kind of link it. We'll see other ways to do that when we go into the practice problem. Create a batch. So you could send like one invoice to multiple customers, and then you got the refund or credit creates a credit memo using the items and prices on this invoice. So if you had a credit situation, like they gave the money, you had to give the money or credit or reverse the transaction in essence. Possibly they'd return the inventory or something like that. Then you have the formatting tab up top. You can preview here. You can manage the templates. The invoice is one of those areas where the template can become important because it is one of those items that you're going to provide to the customer. So therefore, you might want to put your logo on it and that kind of thing. We'll have a whole nother section that gets into that customization process a bit in more detail. First half of the course will be more on the data input. Download the templates, customize the data layout. So these are all customizations of the invoice. Spelling, insert lines. You can delete a line, copy a line. So if you want to make adjustments that you've already created some multiple line items, you can go through and adjust them. And then you can customize the design. Send and ship tab up top. You got the email, FedEx, UPSP, mail invoice, and prepare letter. And then finally the reports tab. You can do a quick check, transaction history. It's for related transactions. And then you can do the transaction journal. This one is nice because if you're learning basically what the journal entry will be, or you want to know what the journal entry will be, in other words, what will be the impact on the financial statements? Remember, every transaction we input will at least have 2 accounts impacted. The invoice actually being quite complicated, especially if you're dealing with inventory in terms of the impact of it, even though the data input should be fairly easy if the items and sales tax and so on are set up properly. We'll talk more about that in a second. You can view the open invoices, basically a report. You can find that in the reports area as well. Sale by customer detail and average days to pay summary. These are reports that we can generate, and we'll look more about them in the reports area at a later point. Back to the main tab. So when you're doing the data input for the invoice, now we have customers that you're going to be dealing with. These are customers as opposed to vendors, people that eventually will be paying us within the sales cycle process. You may have the customer already set up, in which case it would be in the drop-down, or you can add the customer as you go. So we don't have to go to the customer center, for example, which would be here, and the customer center to add a customer that's going to be a new customer as we enter the invoice. Note that as we add the customers, they become more and more important to us oftentimes for most companies, wanting us wanting more detail from them, such as contact information, phone number, and so on, as opposed to vendors when we're paying just normal vendors like the phone company or something like that, where we probably don't care much about anything except what the bill rate will be on it. So you might have a little bit more detail just in normal general business on the customer side to try to pick up more information. Class tracking, we'll talk about that in a future section because that's going to be in a particular type of business such as a job cost business. So we won't go into that in detail now, but it's an interesting function that has many different applications to it. And then the template that they're using, this is going to be the type of template. We'll talk about custom templates at a future time too. The date of the data input, the invoice number should populate automatically as kind of like an internal control. The billing should populate automatically based on the customer that we put in place. They're going to have the ship to items, the terms, which are net 30 in this case, meaning we're going to send out the invoice, which means the invoice means that the major account that should come to your head, two accounts possibly, would be accounts receivable is going to go up and sales or revenue is going to go up. So that means if accounts receivable goes up, that's the account representing people owe us money. And therefore, we have to say, well, when is it going to be due? Net 30 means it's going to be due in 30 days. Therefore, if the invoice was dated 12/15 and I have net 30 terms, it's due, and QuickBooks will calculate the due date automatically on 1/14/25. And then you got the meat of the invoice, the actually items. If you have not set up items yet, then you can kind of set up the items as you go. But you'd really like to think through the items before you do that so that you can standardize what your items will be. If you haven't really thought through your billing process, what your items will be, if you're just thinking, I'm just going to do it hourly, for example, but you haven't really thought through exactly what that is going to be, if you're like a service type of business, you probably want to standardize your hourly rate at the least and possibly think about grouping, even if you're in a service type of business, bundling your service together, because it'll be easier oftentimes if you're able to do so. If you could standardize your offers, for example, with a bookkeeping business, you might first say, I'll just charge people hourly, but it might be easier if you say, hey, look, I'm going to count the number of transactions that I have done for you, and I can actually run a report to see those transactions or see the number of accounts that have been affected, and I will bill you based on the number of accounts that have been affected. That would be easier for you to not have to track your time as easily and think about whether you were as efficient or as awake when you were working 1 hour versus another, and this and that, and which of your employees are working on it and so on, and have different hourly rates. And you could basically standardize it then with an item. You can also set up an item that way, even if you're in a service item, which I think oftentimes is a little bit easier if you're able to do that. If you sell inventory, then clearly you want to think through whether or not you're going to track the inventory through QuickBooks or not. If you're tracking it through QuickBooks, then you got to set up the item properly as well and track the item in QuickBooks as it goes through. Also, if you're dealing with inventory, typically you'll have sales tax that will be applicable, and generally that will be set up when you create the item too. So all that kind of goes into the planning process on how you're going to bill people, and basically then setting up the items, two of the more difficult components in both the business cycle as well as setting up QuickBooks. Once those are set up, then the data input fairly straightforward. You can just say, okay, here's what we got. We got the appliance, picking up the appliance, and then we've got the gas range top. Now, obviously, this is a little bit more confusing even with the data input because it's a job cost system. So you're still going to need more skill there just to know because it's what's going into the job. But in any case, then the rate is $247.50. The amount is that amount too. It's a taxable item, meaning it's subject to sales tax. In the U.S., sales tax is going to be a state and local tax, not a federal tax. So this is another item that needs to be set up a little bit more customizedly than it would in other software. If you're in another country or something that has a federal sales tax on the country level, or like a value added tax, then obviously it might be actually a little bit easier once you set it up because it might be a little bit more standardized. But in the United States, that's something that has to change a little bit more. QuickBooks has gotten a lot better at being able to handle it. And then we've got these next items. We can obviously do multiple items for the invoice, listing them out, having the item number, and then the description will populate automatically if it's set up properly as an item. The rate will set up automatically if you have determined it to do so. If you need to change the rate, then of course you can manually go in and change the rate. And then we have the subtotal. Then down below, we got the tax calculation. So if I hit the drop down, it's picking the proper tax, the government entity that's going to be collecting the tax at the 7.5% in this case. And that gives us the total after taxes, the balance due then being the $1,636.96. Now, next thing you want to think about, what are going to be the accounts affected? Let's pull up the trusty calculator here if I was to enter this, what's going to happen, because it's a little bit more confusing than you would think, because invoices are quite common, but there's a lot of things happening here. We're going to have the invoice that's going to be accounts receivable is going to go up. The receivable is going to be for the full amount of the $1,636.69. So that's fairly straightforward. That's what we're going to bill them. And then the other side is going to be revenue, is what we would typically think of it as. But the revenue isn't going to be this $1,636.69. It's instead going to be the amount that we billed them before the tax. And that's going to be the $1,522.50. So then you've got a difference between this sales amount and the tax of $114.19. Where is that going to go? It's going to go into accounts payable. Like an account, it's going to go into a payable, which will be like sales tax payable on the balance sheet. Now that can be confusing because you might think, why doesn't it work this way? Why aren't I recording sales at $1,636.69? And then when I pay the tax, it should be an expense because I collected this amount in sales, and that is an expense of us doing business. But the idea of the tax is that it's not a tax on the business in theory, although you could think about it from an economic standpoint how it works. But in theory, it's not a tax on the business; it's a tax on the purchase buying, the customer. It's just that the IRS or the government or the state or whoever, the state entity, is using the business as their collection arm, to get the money from the customer. So that means that's the logic of saying we're not going to increase sales by $1,636.69 and then have an expense related to the sales tax, but rather we're just going to record sales of $1,522.50 because that's how much we charge to the customer. And then the state or the government charged them the sales tax, not to us, the business, but to the customer of $1,140.19. We're just collecting on it, and therefore it doesn't hit our income statement, but goes directly onto the balance sheet in the form of a liability. And then when we pay the liability, we'll take it off the balance sheet and decrease cash, and it never then is an expense. So you don't see a sales tax expense, and that's kind of the reason. Then you're also going to have the cost of goods sold if you're selling inventory. This one is a little bit tricky here because we have a job cost system again, but if it was just like normal inventory that you were selling, then you'd have another kind of transaction that would happen, and that would be that the inventory would be going down, and that means that the inventory account would go down, not by the amount here for these inventory cost items, but by the cost of the inventory. These are the sales prices of the inventory. Note that the cost of the inventory is not on the invoice, even though the invoice is going to tell us what is going to drive the transaction to record the reduction in the inventory. How does it do that? It does that because of the items. When we set up the items, we're going to have to set up both the cost and the sales price. So it'll reduce the inventory, and it will also record the cost of goods sold, which is the expense related to us selling the inventory. So really a lot going on with the invoice. Now, if we go over to the tab, which one was it? The reports tab. Actually, I'm sorry. If we go then to the reports tab here, and I look at the transaction journal, that's a good tool for here to show us what the transaction looks like. So notice it gives us the accounts that are impacted in like a journal entry format. So that's really nice if you have like a complex type of account and you're trying to figure out what's going to happen on the income statement. So for example, here, this invoice is having an impact for the accounts receivable goes up by the full amount, $1,636. That includes the sales tax. And then you had these items that are going to go into material income. So these are increasing the income. They broke out the income for the different items that we are selling. But in essence, those are all the items that we are selling. And then we have the difference going to the sales tax. So we have the sales tax, and that's going to be a liability account 2550, the sales tax payable. Now I'm going to go back into the invoice on the left-hand side, so the create invoice. Notice that we didn't have any inventory applied there because in the item area, they put it in here as an appliance, and you can see they put it as a non-inventory part, which means we're not tracking the inventory units within QuickBooks. So we don't have any cost of goods sold side of things or any inventory reduction. So let's take a look at the balance sheet and the income statement. If I go to the balance sheet and you think through this process on the balance sheet, you would expect then the accounts receivable is going to go up by the invoices. If I double click on accounts receivable, we're going to have invoices increasing, and then we're going to have the payments that are going to be decreasing. That'll be the standard kind of process. If I double click on any of the invoices, let's double click on this 3,915. That takes us to the source document, the invoice, which has the total of the 3,915. No sales tax on this particular one. If we were to close this one back out, let's open the first one, that 9569. That one does have sales tax, and you can see the sales tax is included in the total that's included on the accounts receivable side. Closing this out, I'm going to close out the transaction detail as well. Let's now go on over to the profit and loss, which is the other side of the transaction we would expect to see. And let's go into the materials income, for example. Go into the materials income and choose an invoice here. Let's pick this 2,400 on the invoice. So on the 2,400, you can see this amount right there, the 2,400. It's included with the 600, but these two items are going to different income accounts because that's what the items are telling them to do. So for this invoice in the category of income of 2,000 of the category we're looking at, of the materials, we got the 2,400 here, which is the amount showing up in the materials item. Note that it's not including sales tax. If it were, you would have it increased by another 7.75%. So in other words, that 2,400 is what is then showing up here in the income line item. So I'm going to close that back out. Now the difference, the sales tax, where does the sales tax go? It goes on the balance sheet. So if we go back on over to the balance sheet, we would expect some type of liability, not in accounts payable, but some other kind of liability down here, sales tax payable. This then is going up whenever we create an invoice, and then we're going to pay it off with our sales tax widget. So the invoices and the sales receipts are increasing this one. Then if we sold inventory items, and you might think about this first as like just a normal inventory, like you're purchasing and selling inventory, marking up the costs, then you'd have inventory items that would be decreasing on the balance sheet. Those would be asset type of accounts. So if I scroll up, we got the inventory asset type of accounts here. These ones are going to be going down when we have the invoice. Notice that 1,500 that's going down, if I drill down to the invoice, is not on the invoice, even though it's being driven by the items. So meaning we don't want the cost of things on the invoice. We only want the retail price, but we want the invoice driving the decrease to the inventory account. And then if I close this out, the other side of that transaction then is going to the profit and loss report, and that should be in your cost of goods sold account, say here, representing the cost of the inventory that's going down. If I double click that, takes us back to the invoice. So you can think about, if you sell inventory, two things happening with the invoice. One, the sales side of things, accounts receivable going up, sales or income going up, the different sales tax being impacted as well. And then the other journal entry happening at the same time, decrease in inventory for the cost, not the retail price, and then the increase in the cost of goods sold, the expense of us selling the inventory. Back to the balance sheet. Two more things I want to just point out real quick. The accounts receivable up top is also going to be supported by who owes us the money. We could find that multiple different ways, as we saw in the past, but one way with the reports is the sub-report. Go into the reports drop-down, customers and receivables. I'm going to look at the customer balance detail or summary report. So there's our summary. And if we go to the bottom of it by customer, we get that 93,007.93, which should match. If I go back to the balance sheet in the open windows, that amount on the balance sheet. Back to the customer balance detail, these amounts by customer, if we double click on them, should be going up in essence by the invoices. So we get back to the invoice there, which of course, as they affect accounts receivable, will affect the subledger account here. We also have a subledger account, closing that out, for inventory if we're tracking inventory in the QuickBooks system. So that 30,683, we also need to know what kind of inventory it represents. So we could find that reports drop down by going to the inventory item, and then we can look at the inventory valuation summary. giving us more detail about it. The total cost being the $30,683. Back to the balance sheet, we've got the $30,683. So actually, the invoices actually could be a quite complicated kind of a lot of things going on, even though the data input can be quite easy if it's properly set up. We'll talk about how to set it up in future presentations. Then you want to think about the data input, and then you want to think about the impact, like every other financial transaction, on the financial statements, balance sheet, and income statement, and supporting statements, which include inventory subledgers and accounts receivable subledgers.